GM, good morning. Welcome to the Milk Road Show, the daily crypto show for markets that feel as uncertain as when your partner says, I'm fine, but you really know it's code red. I'm your host, Jay Hamilton. It's Friday, May the 2nd. Please note this conversation was recorded yesterday, Thursday, May the 1st. Today, we are once again joined by Michael Nadeau, investor, writer, educator, and founder of the DeFi Report. We are breaking down two topics today, two of our favorite topics, Ethereum and Bitcoin. First, we're going to talk about Michael's recent report and the ongoing conversation, which is how is Ethereum going to accrue value in the long term when so much value is going to the L2s? Michael asked this question in his recent report. Is Base just stealing all of Ethereum's GDP? We're going to talk about that and what his outlook is for Ethereum, and it might even talk a little bit about Solana too. Second, we're going to talk about Bitcoin. Bitcoin is at a monumental moment right now. We're all talking about the decoupling. We're all talking about this shift of Bitcoin becoming more of a global reserve asset. What are the on-chain numbers saying? Is that happening? And what are we looking for in the coming weeks to indicate whether that is truly the direction that Bitcoin is headed in, or is this just another fake out? Before we jump in, I got to ask, do me a quick favor, y'all. If you're listening to this and you like the channel, you like the show, give us a quick like, a subscribe, a follow. Anything you can do helps us out and helps us get more guests on the show to help you guys get educated and invest in a safe manner. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin, CSUSDL. With that, Michael, welcome back to the Milk Road Show.
Great to be here, Jay.
Great to have you as always, my man. Okay, I'm going to start with bringing up your most recent report, and I'm going to read the first paragraph because this really synthesizes what's going on with ETH right now. So, about a month ago, Standard Chartered made headlines when they put out a report titled "Ethereum Midlife Crisis," and the report estimated that Base removed 50 billion from Ethereum's market cap while taking its GDP. The conclusion: ETH's year-end price target was cut from 10,000 to 4,000. Ouch. This begs the question, are they capitulating at the bottom or are they onto a new trend?
Yes, this is the key question. And I think there's been a ton of discussion around this. Obviously, Ethereum has gone through a period of, I don't know if we're going to call it disillusionment, but there's been a period where I think a lot of eyeballs on ETH, a lot of eyeballs on leadership, and a lot of eyeballs on just like, how is this actually all going to come together? Are these L2s actually going to drive value back down to ETH? And we've been doing a lot of work on this. There's this question on like, is what's good for Base actually good for Ethereum, or can Base sort of build on top of Ethereum, capture most of the value from that? And there's not a lot of like benefit to ETH validators, ETH holders. So we've kind of gone through the data on this and gone very deep just on like, is this symbiotic to Base? And we can kind of start there and just kind of look at the data for Base. So I don't know if you want to just pull up a few of the charts. We kind of go through some of the key metrics, keep going down a little bit just to get to Base. Yeah, so here's where things start to get interesting for Base. So Base has done about $106 million of fees. Those are the user fees coming into Base since inception. That looks pretty good. Base is the fastest growing L2. I think everybody's aware of this. You can kind of keep scrolling down a little bit here. GDP, so Base annual GDP, $768 million. We define this as the revenue or the fees that are being earned by all the applications building on top of Base. So they've been able to bootstrap an ecosystem fairly quickly, grow a GDP. They've been able to do all that by building an L2 and not having to set up their own validator sets, which is very costly, very complex. So this is working out very nicely for Base. You can kind of keep scrolling down here. These are the new users. So there's been 157 million new addresses on Base. Yeah, so we don't know. We haven't deduped this. It's almost impossible to dedupe this and figure out how many of those are like new users that came from Coinbase and where they're leveraging their distribution. But we know there's quite a bit of activity on Base. So you can kind of keep coming down here. So here we're looking at the total ETH bridged, right? So Base has been able to benefit by being an L2, having a native bridge right from ETH L1 up to L2. You've got about almost 2 million ETH on Base. That chart is moving up and to the right. Looks pretty good. You have some of those are liquid staking tokens as well. This is just showing the flows. We can kind of skip through the net flows there. And then you got stable coins, right? So you have almost over $4 billion of stable coins on base. Most of that is USDC. So you're growing the network effect of these stable coins and increasing the throughput by doing it on the L2. We can keep going through this. So this is kind of interesting. This is showing the total amount of native assets that are being minted on base. That's the pink, so that's about 6 billion. And then we have the canonical assets that are being moved from ETH L1 up to base. That's another $3.3 billion. And then you have some assets being bridged from other ecosystems, which is a smaller number there. But we can see that base is basically tokenizing assets and growing the network effect of these assets throughout the ecosystem. So really the takeaway here is this looks good for base, right? Base has been able to accomplish their goals very fast, right? Within basically 2 years, becoming the fastest growing L2. And they've been able to do this in a much cheaper way by not having to set up their own validators. And it's worked out quite well. So that's kind of the base piece of this. Now we can move down. And this is really the question I think everyone's asking is this going to work out for Ethereum? Is a venture funded, all these L2s are venture funded companies. They have investors, right? They have to return value back to those investors. And it's in their interest to do that and get the best margins they possibly can. So let's look at sort of what these margins look like for Ethereum. So this is the total rent that Base is paying down to L1. It's only been about $4.5 million since they've moved to blobs. This is post EIP 4844. So it's something, but you can see just even recently there's very little value moving down to the L1 there. So transactions per second. So what is Ethereum trying to get out of this? They want fees. They also want throughput, right? They want the user experience to increase out of this. Like if you think of this as a partnership between Ethereum and Base. So we're seeing that, right? We're seeing transactions per second increase, right? So Ethereum's getting something out of the deal there. We can kind of keep coming down a little bit. And then, the question is like, did Base steal Ethereum's GDP? I would say the answer to that is yes, right? That's kind of the point of the L2 roadmap is, as these L2s grow, the most active applications on Ethereum should move up to the L2, and we've seen that with Aave, with Uniswap, with basically all the top applications on Ethereum are now also deployed on L2s as well, and so that's taking away some of the fees, some of the transactions, some of the burned ETH on the L1. And so I think it's true that yes, Base is stealing Ethereum's GDP. The question is like, this is sort of a short term sort of, you're sort of like disrupting yourself in the short term if you're Ethereum. And so what we're trying to do from here, now that we've established that is happening, is model out, what does this, if Base were to 10x its transaction throughput, and we saw, more L2s do the same, what does that start to look like? And this is probably the meat of the analysis right here. So, and this is where I'm getting somewhat concerned, I would say, in terms of the ability to grow transaction throughput at L2 and keep the fees, under 2 cents or so for those L2s. And we use Tim Robinson's simulator to model some of this out. And so you can kind of go through some of this down. So what we're looking at here in this first simulator, this might be sort of hard to see for people, but what we're doing here, this is the current state. And we're just assuming one L2, and that's Base, and that's the transactions per second that it's doing today. And you can see this is sort of the value accrual down to Ethereum L1. Those are the highlighted numbers at the bottom there. And you have, less than 2 ETH, being burned per day. A little over $3,000 worth of ETH burn coming from Base. That's just today. So it doesn't look great, right? So you can start to, think about what if Base, 5x'd its transaction throughput, its transactions per second. So then we did that scenario. That's the next one. And just so people know, like Ethereum is, scaling out its blobs, and so we factored that in. So they have the Petra upgrade is coming in May.
Hmm.
We
Hmm.
have factored that in here. So the blobs per block is 6 at this. And that's sort of how we're modeling this out. And so we could say, okay, 5x increase in transactions per second. What does that mean for Ethereum L1? We can see, okay, it looks good. You went from a few ETH per day getting burned to 42 ETH getting burned per day, about $67 million. That was at $1,800 ETH price. So it looks better, and you've kept the L2 cost per transaction under 2 cents, which is
Hmm.
great. So that looks pretty good. So now we keep going. All right. So now can we go to 10x? What if Base, onboards, we have some really good devs come onto Base, build some cool apps, things start to take off, and we have 10x the transaction throughput we have today. It starts to get a little, this is where things get a little go off the rails a little bit. So you can see at the bottom, the fees go up, right? So this is great. And this sort of looks like what we saw on Ethereum L1 back in 21, right? When you get congestion, when you get lots of activity, the fees spike. And it looks good for the chain, it looks good for validators. But we can see there that the cost per transaction, that is the cost per user transaction on L2, jumps up to 35 cents per transaction. That's a
Yikes.
10x transactions. Again, we're using the Petra upgrade here. So this is post Petra upgrade in terms of the number of blobs per block. The numbers look pretty good, but is that actually what's going to happen if all these these users are paying 35 cents a transaction? I think they're going to leave and go elsewhere, as we saw, in 21 when people started to look to Avalanche, to Solana, to other chains. So now the question is, okay, well, we know Ethereum is working on this. They're aware of this. Let's now scale out those blobs per block a little bit more, right? So we take the same 10x. We haven't changed the transaction throughput, but what we've done here is doubled the blobs per block from 6 to 12. So this is Ethereum scaling. And we can see what the impact then would be on user transactions and value to ETH. And we can see we got the transaction cost down again. So that's the 0.0018 number there. So that's great. But then what happens to value accrual to ETH? It comes down significantly once again,
Hmm.
to the point where it's about, it annualizes to about 48.9 million. Not a lot, right? So you can kind of see this push pull where, okay, it looks like the chain's going to get congested, and then they're going to do some scaling upgrades, and then the fees are going to drop way down again. So you're going to have this, it looks like there's going to be this sort of push pull as we go. If you keep scrolling down a little bit, we keep kind of going with this analysis. So here we're saying, okay, well, there's obviously more L2s. So let's assume that Arbitrum and Optimism also scale their transactions 10x over the same period.
Hmm.
So now we have 3 L2s all doing 10x what Base is doing today. And we can see, okay, now the numbers look really good, right? You get up to $17.7 billion of blob fees burned, which is almost double the peak fees that the L1 did for 2021. But we can see that we've got a problem where the transactions at the L2 level have jumped up to 64 cents in this scenario. So again, now you need to increase your blobs per block. So we did that
Hmm.
again, and we can see we got down to 17 cents by bumping it up to 24. So we doubled the blobs per block again, but that's still too high, right? So now it's like, okay, can Ethereum keep up with the pace these L2s are growing? That's still too high. We did one more analysis here to go to 33. If you went to 33 blobs per block, which is more of a long-term sort of target for the Ethereum Foundation and where they're going with this, that would get your cost per transaction back under 2 cents at the L2 level, but your annualized fees would be 1.4 billion from blobs. This is just from blobs. That's what Ethereum did this past year,
Hmm.
1.44 billion. So this, I would say that we have not made any like concrete conclusions on all of this just yet. We're still doing a lot of work here, and we're ultimately where we're going with this work is to say, okay, we think there's like 3 different buckets of revenue that can accrue to ETH in the future. One of them is blobs, and this is not factoring in priority fees, which we think there will be priority fees with blobs as well. You're going to have the L2s and the blobs. You're going to have still activity on L1. We don't think L1 is just going to go away. So you should have some activity there. And Ethereum is now focused on scaling L1. And then you have restaking. So like, protocols that are using eigenlayer, you can take your staked ETH, deposit it there. There's additional revenue that you could potentially get through actively validated services. And ultimately, what we're going to do is sort of model that out and get to what we think is a reasonable place for the real yields for ETH moving forward from those three buckets. So this is ongoing work, but we're in the middle of it. This is almost like bear market work for me, where I'm trying to get to a thesis of like, once we, ultimately we think we'll have a bear market at some point. We want to have a very clean thesis for what we think is the winner coming out of that, and that's what a lot of this work is for.
So where does this leave you with your final like takeaways on ETH right now?
Concerned, I would say. I think it's fair for people to be concerned. I put this out there. I want feedback from the community. So, and one of the things that I think was somewhat concerning for us is that we are always looking for people to audit the work. And we were working with, I won't say the name, but we were working with a fairly prominent, research arm in Ethereum, and they kind of ghosted us because the numbers weren't looking like sort of Ethereum propaganda. So that concerns me even more that happened. I do think that Ethereum is turning a corner right now. So you have new leadership coming in. Bankless did a fantastic podcast with Dankrad and another researcher from the Ethereum Foundation. I think they were pretty honest about what has gone wrong over the last few years and are trying to turn a corner. But to me, this throughput issue at being able to scale blobs is the key thing. And then can you corral all the L2s and get them on this like blob standard, create the interoperability, create the user experience? Just a lot of work to come here. Like I said, we haven't fully come to our conclusions yet, but it's, I would say, concerning to start with, I would say.
Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. Meet CSUSDL, the stablecoin built for institutions and DAOs. Don't just hold basic stablecoins, earn yield, all without compromising security, backed by regulated real-world assets and secured with institutional-grade risk management by our friends at Stakehouse Financial. Put your treasury cash to work, earning native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on chain, including Aave, Gitcoin, and hundreds of leading institutions. CYCS USDL is gaining traction at milkroad.com/Coinshift. And if we look at this Sol versus ETH chart that you ended your report with, where do you think this heads, and what are your predictions for? Let's tie in Sol here as well.
Yeah, and we did a little bit analysis I shared on Twitter yesterday, where we're kind of looking at just the real value that's available to token holders for each network, and that kind of strips out value that's either token incentives where it's not coming from users, or it's MEV that's getting captured by like block builders and searchers and not going to validators. And Solana did 488 million of real value available to token holders. That's year to date 2025. And Ethereum was 147 million. So there's just significantly more economic activity available to token holders, which to me, that is the key metric that investors will sort of hone in on. There are monetary premiums, and we can talk about that, and like that's added on to what that real yield is going to be. But to me, this is still mispriced based on the fundamentals, and what the data is telling me is that Solana is just doing more. There is still more TVL, there's still, more network effects, I would say, on Ethereum. And what I'm really looking for is, what do we start to see from traditional finance firms? Are they going to build within the Ethereum ecosystem and choose to do that with L2s? And then this work that we're doing to project out value accrual will give us more insight into how that starts to play out. But it does feel to me that the two assets are still mispriced.
As in they're overpriced is your view.
Well, I think they both might be overpriced, but I would say Ethereum is mispriced relative to Solana. So that gap between Ethereum and Solana should
Needs
close.
to shrink.
Yeah.
Right. Are you for this cycle, for right now, are you trading Ethereum and Solana? Are you in them at all?
I am out of Solana. So we were bullish on Solana after FTX, and we rode Solana all the way up to basically the Trump inauguration. And I'm out of Solana right now. I still hold some of my ETH, and what we're with some of this work, I'm trying to make that come to that conclusion of like, when we start to buy assets with conviction again, which one are we going to buy? And like, we will share that analysis. I haven't made a decision on it just yet, and we'll see where things sort of settle. Like, maybe, if we enter a bear market at some point, we'll see kind of where things settle out at.
All right. Well, we'll get you back on the show at that time to talk about those assets. Okay, let's shift now from Ethereum over to Bitcoin, because that seems to be the trade of the day, the trade of the week, the trade of the month. Not just on the crypto side, but also on the macro side. It's amazing to see how many macro and institutions are piling in and still on the sidelines and coming. Let's talk about your thoughts on what are your overall thoughts on Bitcoin right now, and then we'll jump into some charts from your report.
Sure. So overall thoughts, if we kind of just like take a step back, I always like to zoom out a little bit and just kind of give people my view. We all have sort of different perceptions of like what's been playing out or what has played out. When I think about what's happened since, we got pretty bullish after FTX, and to me, we've seen like the typical stages of like a bull run, where you had kind of the early bull phase in 2023, where Bitcoin starts to reprice. You start to see a little bit of on-chain activity coming back. Solana started to get a bid. We had like I would say a wealth creation phase there, where I would say that was really going back to Q1 of last year. Bitcoin hit all-time highs before that, the halving, and then we sort of went through a period of chop consolidation for 6 months or so. And then the period from, I would say, like October through January felt to me like kind of a blow off top, to be honest, similar to what we saw like when Coinbase went public maybe in 21, as kind of, that was sort of when Trump came into office, as sort of that final sort of point of the cycle. That, with that said, and the way I've been viewing it is sort of like, okay, we may be in wealth destruction phase right now. I think that's unclear. It's still unclear. When I was on a few months ago, I think I said that what we were looking for was to see, corrections. We've seen a lot of that with, the chaos in the markets with tariffs and the macro set up right now. And then we've been looking to see sort of a rally back up, and we're in that right now. So I wrote a report that went out last week, kind of like moment of truth for Bitcoin. And to me, like, we are in that phase. There's a chance, I think, that we are going to actually go up all the way to all-time highs and potentially break all-time highs. And we can go through some of the data that I'm looking at if you want on that Bitcoin report, because to me, it really kind of comes down to ETF flows is kind of the first place I kind of want to talk about Bitcoin. So if you scroll this down. So really what tends to happen after you've had what feels like a little blow off top is short-term, you get the paper handed folks, the sort of transients, the tourists tend to leave, and they will try to leave when you get these sort of retraces back to critical support zones. So the 95 to, let's call it, or 92 to 100K or so is a critical support zone. So we're watching what's happening with short-term holders. I think a lot of that activity is now happening with ETFs. So the on-chain data is sort of evolving now that we have ETFs and other data points. But we saw a massive shift in the ETF flows last week. So there was about 4.4 billion of outflows going back from February through about last week. That made a massive shift, and this chart cuts off a little early here, but we've had 3.6 billion of inflows over the last week. So you almost reversed all of those outflows. So a very aggressive like shift there. And to me, that's important because what we've seen, and we'll get to the long-term holders, is long-term holders are stepping back in the market as buyers, which tends to set a nice base in the market. But you need short-term holders to push you to all-time highs, and this is a signal to me that could be coming here. So if we come down, I'm looking at a bunch of things on chain. Spot volume is still down. So spot volume's down. Active addresses are down about 20%. So we haven't seen like the sort of frenzy that yeah, sorry about that, Jay. We're going to fix this.
It's
We
all
haven't
good.
seen the
I am a
frenzy.
subscriber.
We haven't seen, yeah, I know. We haven't seen the frenzy period. So it's like, let's see where this goes. What tends to happen with on-chain data is price can move first, and the reflexivity of the markets means that the actual on-chain data picks up later. So I'm looking to see if that starts to play out. Coming back to short-term holders, this is kind of what I was talking about. So the price, we are now back to the short-term holder cost basis, and we're going to learn if these guys are paper-handed or if they're going to be diamond-handed, hold and potentially buy more as we show strength in the markets right now. I did just look at this number before we jumped on, and we're seeing a lot of selling from short-term holder, or at least we know they're sending coins to exchanges. We assume those are sales. There's been about 13 billion. So that has continued as price has moved up. We have seen, and the ETF flows look great. With the on-chain data, we're seeing short-term holders sending coins to exchanges. So that's kind of offsetting, I guess, some of the positive
this
momentum. Yep, that's this chart here. And this has continued. Again, this is a few days old, but that activity has continued. It's about 13 billion over the last week or so. So something to keep an eye on. And then, so the question here, and this is kind of what I think is going to happen, or at least my base case of what's happening right now, is long-term holders have stepped in. This chart doesn't show it really well, but that blue line is trending back up. And so you do have long-term holders stepping into the market. This is like the smart money of Bitcoin. These are the people that have conviction, are going to be here for a while. That seems to be setting an interesting base for Bitcoin. So as you see that happening, it's less likely that Bitcoin can correct, more and more
downside
with their buy. Exactly. So you're getting some support there, which is interesting. If you want to come down to the next chart. So this is an interesting chart. It's showing the ratio of long-term holders to short-term holders. And the reason I think this is important is because, again, long-term holders set the base for the market, and short-term holders tend to push, into bull markets to all-time highs. What we tend to see is that the price peaks in cycles when that ratio is at its lowest, meaning there's more short-term holders in the market than not more, but there's an increasing number of short-term holders relative to long-term holders. So we saw it in 17, we saw it in the first peak in 21, and then we saw that also just in Q4. So the question here is, are we potentially going to see a repeat of like kind of what happened in the second leg of the 21 cycle? So if you look at the pink line there, and you look at the second blue peak from 21, that pink line was up. So basically, short-term holders kind of got out of the market. Long-term holders were stepping in, and that was enough to push us to new all-time highs 6 months later. It was kind of a weak sort of second thrust, of the market. But to me, this is what's playing out right now as well. And so what does that mean? To me, it means like we might break all-time highs, but it might, and maybe we get to 120, 130, but it's hard to see like a really big, blow off top. Again, it looks like it might look similar to November of 21. Could be wrong on that, but that's kind of what the data is telling me. I'll pause there if you have any comments.
Yeah, I was just gonna time frame that for us.
Yeah.
When you say that we might break all-time highs, what's the time frame you're thinking about that?
It feels like it could come. I mean, I'm sort of surprised at the momentum that we're seeing even today, more momentum for Bitcoin. Nasdaq, it's very correlated with Nasdaq. So the market is is moving right now. I'm sort of surprised by it. I think there's a lot of dark clouds forming at the same time. So to me, it has to probably happen in the next month if it's going to happen. Because what I'm concerned about is like the sort of hard data. There's stuff happening with tariffs, with sort of like we're starting to see that there's less shipping coming into the LA ports, and
Mhm.
we'll see what the Fed does next week with FOMC next week. If it starts to feel like they are going to cut next week, it's a 3.6% chance right now, so I don't think it's going to happen. But they could indicate that they're going to cut in June, and that's about a 60% chance right now. That could, the market could just look past May and start to, price in cuts, and we could see a bigger, bull market. So yeah, that's kind of the short term views. Longer term views are really, really, really positive, I would say, for Bitcoin.
Mhm.
And a lot of this comes down to what we've seen with tariffs. Something that I've kind of flip flopped a little bit on is like the fiscal spending piece of this and Doge. When I saw Elon Musk getting really aggressive with Doge early on in Trump's administration, I started to think, wait a minute, this is not good for Bitcoin. Fiscal was really what drove the markets and drove liquidity the last few years. And so, you know, what I've been looking at there is fiscal is not, we're actually spending more. The budget deficit's getting worse than it was. And so I'm just looking at that. I'm looking at the rest of the world, Europe, more fiscal spending. We know the Fed's going to have to step in at some point here. And so longer term, I think, looks really good for Bitcoin. And gold as well. Gold looks like maybe it's Bitcoin sort of catching up to gold now. Gold had its run. Now Bitcoin's catching up. But yeah, non-sovereign store of value assets.
Yeah, I want to touch on this chart that you have in your
Yep.
report, which is investors' exposure to global risk assets, and the change that is happening here kind of ties into what you're talking about right now.
Yep. Yeah. So, investors are sort of like stepping onto the sidelines right now in terms of risk assets. Everybody wants to have some cash. People are concerned about, how long tariffs could take, and is it the right time to be getting into risk? I mean, markets are going up though, so certainly some people are taking on that risk. This this is interesting. It looks, if you normally I would look at this and say buy, right? That looks like
Mhm.
everybody's out of risk assets, go in and buy. At the same time, you have, I would say that the equity markets haven't really repriced to a level that I think is appropriate given the forward looking earnings. And that is probably the biggest concern I have with in conjunction with the uncertainty with tariffs, with inflation. It's so uncertain that the Fed is not giving really forward guidance right now. Maybe we get something next week. But for me, like the way I think of this, and I'm a long-term investor, I'm not, this is like a trader's market to me. I'm more of a
Mhm.
long-term investor, and I like to buy Bitcoin when the market value to realized value is, around one or under one. It tends to go below one, below zero even during the depths of bear markets. We're at like a 2.2 right now. So the realized value for Bitcoin, which is a proxy for the cost basis of all the tokens circulating, it's a proxy. It's not an exact, but it tends to be a pretty good indicator. That's about $44,000 right now. I think it'll continue to go up and probably get up to 60,000 or so. But when Bitcoin bottoms, it tends to collapse towards that realized value. There's a few other factors as well. That's when I like to, when I see a confluence of those factors, back the truck up and buy crypto. So I'm kind of like watching the market right now for the most part and staying on the sidelines. Who knows? We'll see how that works out. But for me, I like to wait for the indicators and then have conviction for long term. So
So let's just talk about. I want to go a little bit further on how you're playing it right now. So it
mhm.
sounds like you're mostly holding cash, sitting on the sidelines. You're you're unsure about this current pump right now, this rally right now. Is that a continued rally because everyone's going to go risk on? feels unlikely
Yep.
unless something changes on the macro side and I don't know, Trump and China shake hands tomorrow and boom, we've got a deal and everything's
Yep.
back in order, which is possible, but unlikely.
Yep.
So are you just talk us through how you are playing it right now? Are you buying anything? What do you and then maybe let's talk about what you're looking for and what might make a change in your structure and how you're
Yeah. So
allocating.
bought a little bit of Bitcoin at 77,000. I'm still heavily weighted towards cash. Happy to like collect the 4.5% in CDs until I have more clarity. You know, I'm following all this data and just trying to get a sense of where we're going. I'm not feeling the FOMO to like buy in. What I would like to see, I can tell you what I would like to see, and what I think would be healthiest for the markets to actually go to higher levels would be we get sort of this we realize the market's out over its skis. I think the market's out over its skis right now, and we'll see if I'm right about that. But there may be a realization that okay, some bad news is coming. China, like this China stuff, is going to take a very long time. That's my base case, and so you know the impacts of the tariffs start to become real. Growth slows down, unemployment picks up. You know, we get a recession, and finally the Fed cuts. There's no scenario in my head if that is true, if I'm right, directionally accurate with that, there's no way that Bitcoin doesn't, you know, correct. What I would like to see Bitcoin do in that, if that does happen, would be to stay above the sort of bull market support zone, which would be like 70K, and maybe we just chop around through the summer. Summer sell in May, go away. Summer months are usually not great for Bitcoin, and you sort of kind of like last year, you range in there a little bit, and then we start to get more clarity on tariffs. The Fed starts to ease, global liquidity comes back, and a lot of investors have had time to think about, okay, we're taking money out of U.S. markets, out of the Mag 7. Where are we putting it? Are we going to gold? Are we going to Bitcoin? So to me, that is a very nice setup for then a much bigger move in Q4 that could you could take you to 250,000 Bitcoin or something like that. So
Mhm.
that's in play, I think. But the key thing is that if we do get the recession or the bad news, we don't break the like prior all time or the 70K zone. If you break that, I would be worried that it's more a longer term like bear market setup.
Mhm,
So,
mhm. Yeah, because I think quite simply, if we break that, then the investor sentiment will change, right?
exactly.
You
Yeah.
know, you instantly, if we break that 70K and get down into the 60s, maybe we could handle the 60s. But if we, for sure, if we got down into the 50s, everyone's back out with it's a scam, it's not real, it's
Yeah.
there's no real intrinsic value here, and that story picks up steam again, and that's
And
difficult to deal with.
totally, and people forget that, like, when the price goes down like that, miners the cost to mine Bitcoin right now is, like, 50,000. So, you get these miner capture you have, like, this cascading effect. Usually, there's hidden leverage that gets exposed, and you just get this, like, nasty sort of
Mhm,
reflexive move down just as you do going up. So, you gotta stay out of that. If you can stay out of that, I think it's a really interesting recipe for like a big move in Q4, which would almost look like the 17 cycle.
mhm,
So
mhm.
that's kind of the scenarios how I'm looking at
Not
things.
not
Um,
to mention, at the liquidity setup as well, which is also very uncertain right now because as you said, we're not getting clear policy from the Fed right now, so
right.
we don't know
Yeah.
what they're gonna do other than Jerome just saying, we can be patient, no
Yeah.
worries,"
Yeah.
which, doesn't bode well that we might get rate cuts or QE anytime soon. But as you said, a lot can change if we're looking out to Q4 if the Fed changes their tune and we do get liquidity injection, which seems very likely. We're still in a debt cycle. They still have a lot of debt to refinance. There's a lot of things point towards that. It's very this just this current the past 2 weeks have been. I did not expect this type of rally
Mhm.
this quickly.
Yeah.
Like markets is why markets are so difficult to predict.
Yeah. Yeah.
Like I thought we might rally a little bit, but now Bitcoin's like we're getting up to 100K here It's, and then the decoupling story is picking up steam. What do you think about the decoupling? Like
I
you
would
said
love to
yourself,
see
there's
this.
go ahead.
Yeah, I would love to see this decoupling story play out. I think it's a little early on it. To me, that this idea of decoupling and Bitcoin, which to me, decoupling is more Bitcoin moving to like a risk
Off
off asset.
asset.
It's a risk on asset right now. Mostly is correlated with Nasdaq. What especially during like volatile periods, it's correlated with Nasdaq. The decoupling, to me, that will happen if we see large central banks buy Bitcoin and it's public and we know it, because that's why gold is a risk off asset, because central banks hold it. That's the thing you go to. So, and that could happen where we know some smaller central banks have done that. We know there's a Bitcoin strategic reserve. So, and we should get to some more clarity on that, I think, in the coming months as well.
Mhm.
To me, that's the moment that Bitcoin becomes a risk off asset. But for now, I would say it's likely going to move with Nasdaq for the most part.
Mhm. Yeah, well, two very important dates to be watching are, one is July 4th will be 90 days from the tariff pause, right? So everybody should be watching that. Scott Bessent recently said that there will be a new income tax plan on July 4th as well. So, what happens there? Could July 4th be a positive news day? And then July 23rd is the deadline for the proposal to be made by the crypto, not the crypto summit, but the crypto council of David Sachs and Bo Hines that Trump put together. They have to submit their report by July 23rd. So we got, that's why it's the sell in May and go away. I don't know this summer. This summer feels it's harder. It's harder to, usually I really buy into the sell in May and go away, but this
Yeah.
summer, I don't know. It's difficult to tell. There's just so much noise right now. And so
Yeah.
you don't know when that noise is going to settle down.
Yeah. Yeah. And the way I've played it is, I have like long-term BTC that we just hold and don't sell. There's some ETH as well there. And, if we have this if we have this correction phase, I will scale back in, right? If I see that that scenario we just laid out where we sort of stay above the support zone and you see the macro conditions improving, then I will start adding back, looking for that blow off top that could come, Q4, maybe into 26.
Mm-hmm. Yeah. Yeah. Michael, pleasure to get you back on the show today. Thanks so much for joining us.
Thanks for having me, Jay.
Thanks for listening, and everybody, have yourselves a wicked awesome day, and we'll see you back tomorrow. Another great episode in the books. Thanks so much for listening in, everybody. Truly appreciate your support. People often ask me which crypto credit card I use, and I use the crypto.com card for a few simple reasons. Number one, there's no annual fees. Number two, you get cash back in crypto, so you're building your on-chain dollars. No need to on-ramp. Number three, you get lots of benefits: Netflix subscription, Spotify subscription for free. And finally, you get lounge access if you get one of the higher level cards. Check it out. Link is in the show notes. You won't be upset. Thanks, y'all. Have a great day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note: this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.